Hello everyone, welcome back. Here we're going to work on Jane Johnson's Schedule C. So Jane Johnson's personal information is already inputted. We go to income and she has Schedule C income. She has the lawn care business. So Schedule C, if you look on the income items here, we have going down profit or loss from a business, Schedule C. All right, so I inputted the income already. Once you go in here, you could click on income. So her gross receipts is 200,000. Okay, you input right here. And if she were to sell products, then she may have returns and allowances. Other income generally is any type of income that's not directly related to the type of business. So if she's in the lawn care business, if she sold let's say she sold a car and derived some income from that, then it would be considered as other income because it's not related to her business. All right, so coming back out, again, if she's selling products, then she would have costs of selling the product, cost of goods sold. She does have some general expenses, so we're going to go in there. So going down the list, so we have insurance of 900. We have rent. So notice that there are two, there's rent or lease of equipment and then rent or lease of property. So office rent is considered lease of property. So 2,000 there. Supplies 1,000. Payroll taxes 1,500 and wages 20,000. So we also have phone. As you can see, this is alphabetical and there's no phone. So it's recommended that if it's not on this list, then you want to put it in other expenses. Okay, also to note that this insurance generally is other than health. If it's health insurance, it needs to be inputted right here. Okay, let's click continue and we're gonna find where to input phone. So anything expense that you don't see on that list, you will go to other expenses because here you can name the expense. All right, so once you click here, you could add. All right, so already inputted. So if you click add, then we'll get you to this window here where you can describe and then the amount. So I inputted the phone for 800 and the van expense is 2,000. But you can see that the van was not used entirely for the business. Business mileage is 27,000 and total mileage is 35,000. So if you divide 27 by 35, you will get 77%. And 77% multiplied by 2,000, that's 1,540. I'm going to click continue here. All right, and then now we got to work on depreciation. So it's stated in the problem that Jane is self-employed and Schedule C and Section 179 expense is elected on all eligible assets. So once Section 179, it's a law that was passed. This is to stimulate the economy where generally if the business purchases an asset, it has to be depreciated over the useful life of the asset. So 179 allows the business to write it off in the first year of purchase. So in the year of purchase, it's an election, it's not automatic. So if the business decide to write off the entire purchase amount, of course it has to be business use, then the business may do so. All right, so let's go into depreciation. Assets. So van was inputted. If you want to edit, you could go in. All right, so the van, they placed in service 1-1. Cost was 25,000 and you have to calculate the percentage of use. And then you have to tell the computer whether or not you want to elect Section 179. If you don't elect that, then it will be just depreciated over the useful life. All right, so if you multiply by 77%, then you will get 19,285. So Jane, the problem tells us that Jane wants to elect 179. So we're going to input the 19,285, and then down below here, you need to input the depreciation method. So it's a 5-year property. IRS has a guideline for different types of property. So auto is a 5-year property. And listed property generally is a type of property that could be dual use. So like computers, cars, and vans that are over 6,000 pounds generally are not considered listed property. SUVs, luxury cars, or regular passenger cars are considered dual purpose. So it's considered listed property. So listed property is under a different type of rule in terms of depreciation. All right, so we're going to go to continue here. And that's the first one. So Jane also has 3 other types of computer, printer, and lawn mower. All right, so we're going to add another description of the asset. So for computer, it was purchased during the year 2018 on May 18, 2018. The cost was $2,200. Percentage use, we're going to assume 100%. 179, she wants it all, so we're going to take 179. 179 election is only available for the first year. Okay, so in the year of purchase, that's when the taxpayer will have to elect 179. So this is a required. So computer is considered 5 years. So we're going to still check 5 years and then continue. All right, so the next property asset we're going to input is a printer. Date, place, and service was 3/1/2015. The cost of that was $900. And then the problem tells us that 179 was not taken on assets purchased prior year. So down below here, we're going to assume that there's no prior year special depreciation. And then you'll have to calculate. So the printer was purchased in 2015, so it does 179 does not apply. It should have some prior year, perhaps special depreciation and accumulated depreciation, but we don't have that information, so we're not going to input that right here. But if this is a real return, you would need that information. All right, so depreciation method, it's a 5-year property, and we click continue here. The next one is the lawn mower. It's already inputted here. So the lawn mower date, place in service is also March 1st, 2015. So this is a prior year, place in service in prior years. Cost is $2,000. Percentage of business use is 100%. Since it's the prior year already placed in service, it's not the current year 18, then 179 does not apply. It's not eligible. This again should have perhaps special depreciation and also accumulated depreciation. Lawnmower is a 7-year property. So if you're confused on what maker's 7-year, the drop down, which one to choose, IRS has published a table to guide you. All right, so we're going to continue. And so we're done inputting all the depreciation assets. I want to continue out of here. And all right, so going out here, you can see that there's another car and truck expenses here. So for this software, car and truck expenses is to input if you were going to take a standard deduction. So if you have a car, truck, or a van, and there's a standard mileage rate you can take. So it's generally published by the IRS. Right now it's about 55.5 cents per mile. So if you're taking the standard rate, then you may not take depreciation because depreciation is only if you're taking actual. So on this return, we're taking the depreciation. We also took the van expense on under the general expenses. So van expense may include repairs and maintenance, and may include fuel. So those are the expenses that you will input in general expenses. Some of the tax software, you would input the information as far as mileage and your actual, and it does a comparison for you. But for this tax layer software, it doesn't do that. So you just have to make a choice. All right, so we are done. We're going to go to summary and print. And I'm going to show you. All right, so we're going to go in and look at the first page. Of course, you already know that it's the basic information. Second page is kind of like the summary. So from Schedule 1, which includes a Schedule C, we have the income here. And then standard deduction is given to her, $12,000. Let's look at Schedule 1. You're required to submit Schedule 1, and this comes from Schedule C. And the self-employment tax is Schedule SE. That's automatically prepared for you. Anytime you prepare a Schedule C, the SEs are automatically calculated and prepared. All right, so let's look at here. There's no itemized deduction. All right, so this is Schedule C. So we have the 200,000 gross receipts that we inputted. And we'll look at depreciation in a minute here. Insurance, we did rent, we did supplies, taxes, wages, and then other expenses is made up of these two items here that we inputted, phone and 77% of the van expense. Moving down. This is the Schedule SE. It's based on the income that's reported on Schedule C. It's basically if you have a W-2, you pay 7.65% in FICA, which is the Social Security and Medicare, and self-employed taxpayers will also have to pay that as well. So this is calculated here. All right, so this is the depreciation schedule, Form 4562. So you can see that in the first part, it's all about this 179 election. So we elected van, even though it's 25,000, only the business use is eligible for 179. Computer, 100% use, so 2,200. And the makers, it's calculated at 354. So we'll go down further down. Here's a detailed schedule. So you can see that printer 900, basis 900, and then after calculation, she's able to take $104 in depreciation. The lawnmower, $2,000, and also after calculation is $179. But the van, 119,285 is depreciation, and it's under. You can see the column here is section 179 for the current year, and also for the computer. Now, for the other two properties, it was placed in service prior to 2018. Generally, and under this column, it should have the accumulated depreciation, which means it in 15, the printer and lawnmower would have been taken some depreciation, and also for 16 and 17. So that would go here. But since we didn't have the information and that's why it's blank here. Also, bonus depreciation as well. If it was taken, then it would need to be inputted, and then it's going to show up in this column. All right, so this concludes the tax return for this taxpayer. Thank you for watching.